Hello, world. Welcome back to my channel, where we offer clear and practical advice about personal and business finances without the jargons. Make sure to follow us on Instagram at JMC underscore accounting and to hit that subscribe button. And check out our blog site where we post every Monday, Wednesday, and Friday. Today, at JMC Accounting, we're going to talk about understanding the W-4 withholdings form. If you have ever been a W-2 wage earner, then you filled out one of these forms on day one of work. But what exactly does the W-4 form do and why does it matter? Let's break this down into simpler terms. The W-4 form tells your employer how much to withhold in federal income taxes from your paycheck. You really want to get this right so you don't owe a ton of money at the end of the year for not having the correct withholdings amount. This is one of the biggest issues I see with clients in my practice at the end of the year when the client owes the IRS. I'm always stressing to them that they must change their withholdings on their W-4 form to have more money withheld in federal income taxes. A good rule of thumb is to check your income to withholdings right around June, July. That's the halfway mark of the year to ensure that any adjustments needed can take place on your W-4 during that time so you don't have any surprises at the end of the year when Uncle Sam is asking for their money. Now, fellas, I don't know why, but most married couples that I see, it's usually the men that don't go back and change their W-4 withholding forms after they get married. This is very important, especially if you're married filing jointly, because it can affect whether you get a tax refund or the amount of taxes that you may owe at the end of the year. So it's very important when we have these life changes that you go back and update your W-4 form. Let's go over some of the key parts of the W-4. So, in part one is going to be your personal information. That's going to be your name, your address, social security number, and your filing status, whether you're single, married, or had a household. We already have our friend here, Peter Griffin, who's filled out his information. And as you can see, he's going to be single just for now. Part two, we're going to enter whether we have multiple jobs or if our spouse works. If you have more than one job or if your spouse works, this section helps to adjust withholding so you're not underpaying. For Peter's purposes, we don't have a multiple jobs. We'll just leave him as a one job person. Step three, we're going to enter if we have any dependents. If you have kids or other dependents, you may qualify for certain tax credits that reduce how much tax is withheld. Now remember, we talked about this before, tax credits versus tax deductions. In this section, what does a tax credit do again? It lowers our amount of taxes owed. Step four is going to be other adjustments. You can list other incomes like your freelance work, deductions, or extra amounts you want withheld. Look at B. Remember we talked about tax deductions before. What is a tax deduction? It lowers your taxable income. And then step five, we're going to sign as the employee, and then our employers will take care of the rest. Okay? So let's go back for our example. We're going to use Peter Griffin. We have all his data in for part one. Next, we're going to come down. Since he's single, we can't claim any dependents. Remember, when you're single, you can't claim a dependent. You have to be either married, filing joint, or head of household. Step four, we're going to put in, we think Peter's going to take something more than a standard deduction. That's what we're going to focus on is part B. So what we're going to do is we're going to go to page 3 of this worksheet. So here we are on page 3 of this worksheet for step 4B, the deductions worksheet. So what we're going to do in part 1 is we're going to enter our estimated itemized deduction. And remember, there's 3 different types of deductions we could take. The standard deduction, based on your filing status, is automatic. Your itemized deduction, based on your filing status, as long as it exceeds the standard deduction, you'll take your itemized deduction. So for Peter, since he's single, he has to exceed $15,000 in the standard deduction in order to take his itemized deduction. We'll say Peter's going to take a $20,000 itemized deduction is what he's estimating for the year. Next, on line 2, we're going to enter what the standard deduction would be. So for Peter, since he's single, it's going to be $15,000. Now we're going to look at part 3. If line 1 is greater than line 2, subtract. So our line 1 is greater than our line 2, and that's going to be $5,000. Next, we're going to enter our estimate of the student loan interest, deductible IRA, and other certain adjustments. And remember, this is our above the line deductions. That's what we're going to take here. And we're going to say Peter doesn't have any above the line deductions just for simplicity of this video. So now we would add line 3, our itemized deductions, plus our above the line deductions to get what we'll put in that box above in box 4, which is going to be $5,000. So we'll take our $5,000 and we will put it right in here in 4B. And then Peter, he won't have any extra withholdings that he doesn't think he'll need, and he'll sign, and his employer will take the rest. Now let's go back and change a couple things real quick. Let's go back and say Peter's married, filing joint. Him and his spouse both work, so we're going to check this box off. But since they both work, now we're going to go back to page 3 to complete. So here on page 3, what we're going to do is we're going to look for the line that's most appropriate for us. And for Peter, him and his wife Lois, we're going to look at box 1, which is 2 jobs. If you have 2 jobs, or if you're married filing jointly and you and your spouse each have 1 job. So next what we're going to do is we're going to go to our table on page 4, and we're going to look for our filing status. For Peter, it's going to be married filing joint, and then you have single, married filing separate, head of household, but for our purposes, we're looking at married filing joint. Lois makes more money than Peter. So what we're going to do first is we're going to look for our higher paying salary. So we're going to say that Lois makes $79,999. And Peter, we'll say for simplicity issues, only makes $40,000. So now we arrive at our number based on the columns. So our higher paying spouse, our lower paying spouse. We just look for the columns and the rows that match up, and we get 3770. So we're going to go back up, and in box 1, we're going to put 3770. And then we're going to come down, and we're going to enter the number of pay periods per year for the highest paying job. So we'll say, for simplicity, Lois gets paid bi-weekly. So we'll put 26. And then what we'll do is we'll take our 3770 and divide that by 36. So that comes out to, let me get my calculator out. That's going to come out to 145. So what we're going to do is we're going to take our 145, and that's going to go to step 4C, which when we go back up is our additional withholdings that we need to have withheld from our paycheck. So we're going to put 145 in here, and that way our employers know that we need this additional withholdings, so that way we don't owe at the end of the year. Okay? So let's go back up, and let's say Peter is still married, filing jointly, but this time we're going to keep our extra withholdings the same, but this time we're going to say that they have 3 children, Meg, Stewie, and Chris. So now we're going to put the number of qualifying children under 17, and we'll say all 3 are under 17. So we're going to do 2,000 times 3, which gives us a $6,000. Remember, this is our credit, and what do credits do? They lower our taxes owed. So we're going to put our 6,000 in there. And then if we had any other dependents that were over the age of 17 that qualified, we will put our 500 and times it by the number of dependents there. So for simplicity, we'll say they don't have any. And we'll say we'll put our 6,000 here. And what we'll do, and that will complete our W-4 form. So you'll have your $3,000 in credits that you're expecting and your $145 in additional withholdings that you'll need. And then he'll sign, date, and go back. Let's go back and change one more thing. Let's say that Peter's still married, filing joint to Lois. They still have their 3 children, the credit they expect. But this time, for deductions, they're not going to take the standard deduction for married, filing joint. They're going to take the itemized deduction. So let's go back to page 3 to calculate that. So we're going to go down. Now this time we see they're married filing jointly, so they have to have their standard deduction is $30,000. So in order to take the itemized deduction, they got to have more than the standard deduction. So this time we'll say that they think that their itemized deduction is going to be $40,000. So we enter our $40,000 on line 1 because that's what we're estimating our itemized deduction to be. We'll put our standard deduction for married filing joint, which is $30,000. We'll take the difference, which is $10,000, and we'll say Lois went to school, so she expects to pay another $5,000 in student loan interest for our above the line deduction. And now we have $15,000 that's going to be entered into our deductions on our W-4 form back on page 1. That's going to go right in here. So now our W-4 form is complete. We have Peter, who is married filing joint to Lois. They have their 3 kids, Chris, Meg, and Stewie. So they're going to get a $6,000 credit. And then they believe that their deductions is going to be higher than their itemized deduction is going to be higher than their standard deduction. So we're going to put our $15,000. And since Lois is a higher earner, we're going to have some additional withholdings that we're going to have each pay period at $145. And then Peter will sign, his employer will take the rest, and that is pretty much it for filling out the W-4 form. So let's talk about when should you update your W-4 form. You don't just fill it out once and forget it. You should review it, like I said, either at the 6-month mark if you're not sure where you're at, or you should update it whenever you have any major life changes, such as you're getting married or divorced, you have a child, you start or stop a second job, your income changes significantly. Now, there are some tips for getting it right. You want to use the IRS's online withholding estimator to make sure that you're on track for where you need to be for your withholdings. And you can do that by going to the IRS's website right here. So right here on the IRS's website, you can also use this calculator to ensure that you're withholding enough to make sure if you're on track. Just follow the prompts for your information that applies to you all the way through, and this will help you to ensure. But it's always safe to have a little bit more withheld than not enough, so you can adjust later. Remember to always keep a copy of your W-4 for your records. Bottom line is the W-4 form may seem like another piece of paper, but it plays a big role in your financial life. Understanding it can help you avoid surprises at tax time and keep more control over your paycheck. Well, that's going to do it for today. Drop a comment below and let me know what you think. Remember to hit that subscribe button. And check out our blog site for the latest postings. I'll see you next time to break down the understanding of the expense categorization tips for small businesses.